Welcome to the Wealth Studying Podcast Video Edition. I'm your host, John Pugliano. I'm also the founder and money manager of InvestableWealth.com. In today's episode, we're going to discuss why you need to be aware of ETF decay. And what I mean by that is that because of expenses involved in managing the funds and in the transaction costs of the funds, oftentimes they can lose a lot more value than you think they do, just like a radioisotope would decay. So when your individual ETF is not keeping track or is not correlating with the underlying index or commodity or sector that it's supposed to be linked to, when the value of that ETF degrades and does not hold the price, that's what a decay is. I want to start off by saying that as far as exchange-traded funds go, that's what ETFs are. I am a huge fan of exchange-traded funds. In fact, I think over the last 50 years, the two best things that have happened in the financial industry, and particularly that has happened to help out the little guy, to help out the retail individual investor, the two biggest innovations that have come down the pike over my lifetime have been exchange-traded funds and the Roth IRA. Now, an ETF is a fantastic way for you to be able to invest. You need to think of it as a financial tool. A financial tool is no different than any other tool. Tools always work best when they're used for their intended purpose. And so to avoid having excessive decay in your ETFs or to ensure that you're getting the most out of your ETF, you need to use it for its intended purpose. So let's talk about what some of those purposes are. The primary purpose for an exchange-traded fund, and I think the most absolutely best use of an exchange-traded fund, is to provide you with broad diversification into a market index. And that would be something like an ETF SPY or the ETF VTI. SPI would give you broad exposure into the S&P 500. That's the 500 largest American publicly traded companies. So that gives you very broad exposure. It's a great way to be able to even put a small amount of money to work and still have the protection of broad diversification, not having to put all your eggs in one basket. VTI is a similar ETF. It's offered by a different company. It's offered by Vanguard. It is the total U.S. market fund. So while SPI would just have you invested in the top 500 companies in America, VTI has you invested in all the publicly traded companies in the U.S. stock market, and that's, some 7,000 stocks or more. So again, the primary purpose that I believe that an ETF provides you is to give you that broad diversification and allow you to be invested into a market index. Another great function or purpose of an exchange-traded fund is to allow you the opposite of having broad diversification, and that's the ability to concentrate and invest in a narrow, specific sector. So that would be an example of TNX or KBE. Those are two very popular, very liquid ETFs. TNX is an ETF that is only invested in transportation stocks. KBE is an ETF that only invests in banking and financial type stocks. So again, a great use for exchange-traded funds is to get a narrow position. Now, continuing down the spectrum of uses for ETFs, ETFs are an excellent way for you to be able to trade in a commodity. For example, owning GLD, which invests in gold, or owning USO, which invests in oil. There are literally hundreds of different ETFs that will allow you to invest in a specific commodity. And finally, that brings us to yet another function, another purpose to use exchange-traded funds, and that's to trade a short position. These are called inverse ETFs, and what they allow you to do is to take a short position, meaning you're investing in a sector or a commodity, not wanting it to appreciate, but wanting that underlying equity to devalue. And so you're selling it short in effect. And you can make a lot of money doing this, but it also involves a great degree of knowledge and sophistication. So if you felt that the S&P 500 was going to have a pullback, was maybe going to go into a bear market, you could invest in SH. SH is an exchange-traded fund that shorts the S&P 500. Likewise, if you think that oil is going to go down in price, you can invest in an ETF called DNO. DNO is an inverse of the oil trade. ETF decay occurs when the price of the exchange-traded fund that you're in is not tracking in a correlated way with the underlying security. So if you own SPY, which is going to give you broad exposure to the S&P 500, well, that's a broad market index fund, and SPY very closely correlates with the S&P 500. So if you turn on the news and you hear that the S&P 500 is up 1%, well, most likely SPY, your exchange-traded fund that's invested in that index, is going to be up close to 1%. But as you get into each of these more specialized uses for exchange-traded funds, concentrating into narrow sectors, or trading a commodity, or trading a short position, each one of these levels of increasing sophistication carries with it a lot more risk and also a great deal of cost from transaction fees and making those trades work. And so along with that risk and all those increased transaction costs is decay. The fund managers that are managing that ETF, they have to pay for those positions. Those are transaction fees that you don't see, but those operating costs and transaction costs are paid for by a reduction in the price of the principal of that exchange-traded fund. And so, for example, let's say that you own a gold ETF and you hear in the news that gold was up 2% today. And yet when you look at your gold ETF, you see that you were only up 1.5%. Well, that difference between what the actual underlying commodity was up and the amount that your exchange-traded fund was up, that's the amount of decay. And that decay can be quite significant. Think about what it costs to invest in a commodity or to sell a position short. Well, there's a great deal of transactions fees. They may have to invest in futures contracts. There could be options of selling or purchasing calls and puts. In the case of a commodity, there could be the actual storage of the commodity. The ETF GLD actually owns physical gold, and so they have to not only purchase that gold, which would involve transaction fees, they have to not only buy it, but when people liquidate that fund, they have to sell it. So the fund is going to incur fees for both of those transactions, the buying and the selling. And then they also have to physically store that gold, and they have to provide security for it so the gold doesn't get stolen, and they have to ship it around to different storage areas. So there's a lot of costs associated with the exchange-traded fund GLD. And you pay for those costs in the difference between the price of GLD and the actual price of gold on a daily basis. And so the more sophisticated, the more complicated, the more expensive the transactions cost, the more your ETF is going to degrade. So think of those 4 uses or the 4 purposes I talked about with the exchange-traded fund. If you're going to own the broad market indexes, which is an excellent use of an ETF, well, that has very low costs. It's very inexpensive. And so consequently, SPY, QQQ, these broad-based market index ETFs, they do very well. They're very inexpensive. They experience very low degradation, almost no decay. As such, these broad market ETFs that follow these indexes have a very low decay. They're run very efficiently, and they closely track the index that they're associated with. On the other hand, ETFs that deal with commodities or inverse ETFs that take short positions, these ETFs operate very inefficiently. Therefore, they have a high rate of decay, and in most cases, it's very likely that there's going to be a great disparity between the underlying commodity or the underlying ETF. Let me show you how this works. Here's a chart of the price of oil. This is a chart that tracks U.S.-based oil, which is West Texas Intermediate. Now you can see that over the last 3 years, going back to 2014, the price of oil has come down significantly, but at the same time, there's been a lot of peaks and valleys in there. And so had you made the right call, whether you went long or went short on oil, you could have made a great deal of money. Now, the problem is that you can't just go out and buy barrels of oil and hope to sell it and make a profit. But you can buy exchange-traded funds that let you take long or short positions in oil. For example, you could buy the ETF USO, which tracks West Texas Intermediate Oil. Now, in this chart, I've added USO to it, and you can see the performance of USO is the red line. Through most of 2014 and into 2015, when the price of oil was plummeting, USO correlated almost exactly to the price of West Texas Intermediate. However, you can see that around April of 2015, a disparity started to take place. And that discrepancy between the actual commodity, West Texas Intermediate Oil, and the ETF that tracks it, USO, that discrepancy, that disparity continued to grow until when you get out into the year 2016 and into 2017, you can see that the difference in the price of those two assets are significantly different. Now let's look at an extreme example. Back on February 11th, 2016 is when West Texas Intermediate hit a low. On that day, oil hit a low of $26.19. The corresponding price of the ETF USO on that day was $7.99. Fast forward a year later, in March of this year, March 1st, 2017, the price of oil had risen up to $53.82. Now, correspondingly on that day, the price of the USO fund was at $11.40. Now, clearly, both oil and the ETF that tracks the price of oil were both up over that year. But the actual underlying commodity, oil itself, had you been able to invest specifically in oil, that had appreciated over 105% over those 12 months. While at the same time, the ETF USO was only up about 42.5%. And so you can see that even though you might have thought that oil was going to appreciate and you bought the USO as a fund to track the price of oil, you would have been correct. You would have caught an uptrend, but you would only captured about half as much of that appreciation. And the difference of that 105% versus only 42% is the decay rate of the ETF USO. Now, there's nothing immoral or criminally wrong or nothing nefarious about the way USO operates. It's just very expensive in terms of transactions fees and futures contracts and all the things associated with managing a fund that tries to track the price of oil. And so consequently, particularly during periods of extreme volatility, that fund can degrade significantly. It doesn't track the underlying commodity that it's attached to. So when you invest in exchange-traded funds, be extremely cautious when investing in commodities or investing in ETFs that go down into very niche, illiquid sectors, or definitely be very concerned when you're investing in an inverse fund or a multiple type fund that usually is called a 2X fund or a 3X fund or a extra bear fund. Any of those can have high levels of degradation, and I would say that in most cases you should either avoid them entirely or use them simply as day trading tools where you're not holding on to them for more than 24 hours or so. Well, hey, as always, that's just my 2 cents. I'm not offering any specific investment advice. I'm just giving you my opinion, and I'm full of opinions. If you'd like to hear more, please subscribe to the YouTube channel. You're also welcome to put comments down below, particularly topics that you'd like to hear me address on future video episodes. And then also, hey, don't forget to go out and listen to the actual Wealthsteading podcast. That's available on iTunes or whatever your favorite podcasting syndication program is. And so until the next episode, as always, this is John Pugliano wishing you the very best returns.